Handling market volatility. Conventional wisdom says that what goes up must come down. But even if you view market volatility as a normal occurrence, it can be tough to handle when your money is at stake. Though there is no foolproof way to handle the ups and downs of the stock market, the following common sense tips can help. Number one, don't put all your eggs in one basket. Diversifying your investment portfolio is one of the key tools for trying to manage market volatility because asset classes often perform differently under different market conditions. Spreading your assets across a variety of investments, such as stocks, bonds, and cash alternatives, has the potential to help reduce your overall risk. Ideally, a decline in one type of asset will be balanced out by the gain in another, though diversification cannot eliminate the possibility of market loss. One way to diversify a portfolio is through asset allocation. Asset allocation involves identifying the asset classes that are appropriate for you and allocating a certain percentage of your investment dollars to each class. Example, 70% to stocks, 20% to bonds, 10% to cash alternatives. A worksheet or an interactive tool may suggest a model or sample allocation based on your investment objective, risk tolerance level, and investment time horizon. But that shouldn't be a substitute for expert advice. Number two, focus on the forest, not the trees. As the market goes up and down, it's easy to become too focused on day-to-day returns. Instead, keep your eyes on your long-term investing goals and your overall portfolio. Although only you can decide how much investment risk you can handle, if you still have years to invest, don't overestimate the effect of the short-term price fluctuations on your portfolio. Number three, look before you leap. When the market goes down and investment losses pile up, you may be tempted to pull out of the stock market altogether and look for less volatile investments. The modest returns that typically accompany low-risk investments may seem attractive when more risky investments are posting negative returns. But before you leap into a different investment strategy, make sure that you're doing it for the right reasons. How you choose to invest your money should be consistent with your goals and time horizon, of course. For instance, putting a larger percentage of your investment dollars into vehicles that offer asset preservation and liquidity, the opportunity to easily access your funds may be the right strategy for you if your investment goals are short-term and you'll need the money soon, or if you're growing close to reaching long-term goals such as retirement. But if you still have years to invest, keep in mind that stocks have historically outperformed stable value investments over time, of course, although past performance is not a guarantee of future results. If you move most or all of your investment dollars into conservative investments, you've not only locked in any losses you might have, but you've sacrificed the potential for higher returns. Investments seeking to achieve higher rates of return also involve a higher degree of risk. Number four, look for the silver lining. A down market, like every cloud, has a silver lining. The silver lining of a down market is opportunity to buy shares of a stock at lower prices. One of those ways you can do this is by using dollar cost averaging. With dollar cost averaging, you don't try to time the market by buying shares at the moment when the price is lowest. In fact, you don't worry about price at all. Instead, you invest a specific amount of money at regular intervals over time. When the prices are higher, your investment dollars buy fewer shares of an investment. But when the price is lower, the same dollar amount will buy you more shares. A workplace savings plan, such as a 401k savings plan in which the same amount is deducted from each paycheck and invested through the plan, is one of the most well-known examples of dollar cost averaging, in action, of course. For example, let's say that you decide to invest $300 each month, as the illustration shows. Your regular monthly investment of $300 bought more shares when the prices were low and fewer shares when the prices were high. Although dollar cost averaging can guarantee you a profit or avoid a loss, a regular fixed dollar investments may result in lower average price per share over time, of course, assuming you continue to invest through all types of market conditions. Number five, making dollar cost averaging work for you. Get started as soon as possible. The longer you have to ride out the ups and downs of the market, the more opportunity you have to build a sizable investment account over time. Stick with it. Dollar cost averaging is a long-term investment strategy. Make sure you have the financial resources and the discipline to invest continuously through all types of market conditions, regardless of price fluctuations. Take advantage of automatic deductions. Having your investment contribution deducted and invested automatically makes the process easy and convenient. Number six, don't stick your head in the sand. While focusing too much on short-term gains or losses is unwise, so is ignoring your investments. You should check your portfolio at least once a year, more frequently if the market is particularly volatile or when there are significant changes in your life. you may need to rebalance your portfolio to bring it back in line with your investment goals and risk tolerance. Rebalancing involves selling some investments in order to buy others. Investors should keep in mind that selling investment could result in tax liability. Don't hesitate to get experts to help if you need to decide which investment options are right for you. Number 7, don't count your chickens before they hatch. As the market recovers from down cycles, elation quickly sets in. If the upswings last long enough, it's easy to believe that investing in the stock market is a sure thing. But, of course, it never is. As many investors have learned, and that learned it the hard way, becoming overly optimistic about investing during the good times can be as detrimental as worrying too much during the bad times. The right approach during all kinds of market is to be realistic. Have a plan, stick with it, and strike a comfortable balance between risk and return. Don't forget that while there are sound strategies, asset allocation and diversification can't guarantee a profit or protect against the possibility of loss. All investing involves risk, including possible loss of principal, and there can be no guarantee that any investing strategy will be successful. Past performance, as usual, is no guarantee of future results. To learn more about investment strategies for volatile and uncertain markets, I have a 1-hour webinar going further into the topic. The webinar link is in the description. Your plans for the future shouldn't depend on the daily fluctuations in the stock market. Gains and losses are part of investing. By using deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to constantly adjust your portfolio to react to today's news. Again, the webinar link is in the description. Click on it and we'll see you there.